Hi, I'm Kevin Fox, President of Alliance Financial. Welcome to this market and economic update. In this video, we will cover the biggest themes from the first half of 2026 and explore what helped drive solid market performance during a challenging period. There is a saying that smooth seas do not make skillful sailors. The first 6 months of this year certainly put that idea to the test. Investors faced a war in Iran, rising oil prices pushing up inflation, and continued debate around artificial intelligence. And yet, markets reached new all-time highs. Company profits grew at a double-digit pace, and many types of investments delivered strong returns. Over the next few minutes, we will walk through several important themes that could continue to shape markets in the months ahead. Let us begin by looking at where we currently stand in the business cycle. The business cycle refers to the natural pattern of economic growth and contraction over time. The current period of growth started back in April 2020, near the lowest point of the pandemic. That means its expansion is now in its seventh year, which may come as a surprise given how often a recession appeared to be just around the corner. As this chart shows, some business cycles have lasted 10 years or more, including the recovery that followed the 2008 financial crisis and the long expansion of the 1990s. The fact that the economy is still growing is a sign of its underlying strength. Today, the overall picture looks encouraging. Inflation is higher than we would like, but may be close to its peak. The job market has bounced back after slowing last year. Business investment has increased, and consumers are still spending even if they feel somewhat cautious. Historically, conditions like these have tended to support financial markets over the long term. Next, this chart shows how a broad mix of investment types have contributed to solid portfolio returns so far this year. The second quarter was especially strong across many areas, partly because markets began to recover at the start of April after the initial shock of the conflict in Iran. Company profits have also been a key driver of performance. Earnings for S&P 500 companies, which tracks 500 large U.S. businesses, rose more than 20% over the past 12 months. Another notable development has been a wave of high-profile initial public offerings. An initial public offering, or IPO, is when a private company sells shares to the public for the first time. Notable examples include SpaceX, with listings from OpenAI and Anthropic anticipated. These events tend to generate a lot of short-term excitement, but what truly matters for investors is how these businesses perform over many years. That is typically where lasting value is created. It is also worth pointing out that U.S. stock prices are on the higher side. The S&P 500 is currently trading at around 20 times earnings, which is above the long-term average of 16 times. This does not predict what markets will do next, but it is a good reminder to keep a well-balanced mix of investments. Turning now to inflation, the conflict in Iran disrupted the flow of oil through the Strait of Hormuz and pushed the price of Brent crude oil to nearly $120 per barrel earlier this year. Overall inflation, as measured by the Consumer Price Index, which tracks the cost of everyday goods and services, climbed to 4.2% in May. However, core inflation, which removes the more unpredictable food and energy prices from the calculation, held at 2.9%. This suggests that price pressures in most other areas of the economy have remained more moderate. The encouraging news is that oil prices have since dropped back around $70 a barrel, and many economists believe inflation may be near its high point. This outcome is similar to what happened after other major geopolitical events that affected oil supply, such as Russia's invasion of Ukraine in 2022. Once the situation stabilized, prices and inflation tended to ease over time. Next, let us look at market volatility, which refers to how much investment prices move up and down over a period of time. How investors choose to respond to that movement often matters more than the volatility itself. The VIX, which is a widely used measure of how much volatility investors expect in the stock market, is currently below its long-term average. As this chart shows, periods when volatility was high have also created opportunities for patient long-term investors. The largest drop in the S&P 500 so far in 2026 was about 9%. That kind of decline is never easy to sit through, but markets have not only recovered from that low point, they have gone on to reach 24 new all-time highs this year. Investors who stayed the course during the difficult moments have generally been rewarded. Finally, one result of market uncertainty in recent years is that a record amount of money is sitting on the sidelines in cash. Assets held in money market funds, which are a type of low-risk account that invests in short-term debt, have now reached $7.9 trillion. That is more than double what it was before the pandemic. While holding cash can feel like the safe choice, it carries a real hidden cost. With overall inflation running above 4%, the buying power of cash is actually shrinking over time. Even when short-term interest rates look appealing, they often fail to keep up with inflation in the long run. That is why holding a balanced mix of investments designed to support growth, generate income, and protect capital remains so important, particularly as this economic cycle continues to age. We hope you found these insights helpful. If you'd like to learn more about any of these topics, please don't hesitate to reach out. We look forward to speaking with you.